Hello, everyone. My name is Deborah Cantor, and I am the Ort America Chair of Planned Giving. I work with and learn from Robin Isaacson, Ort America's talented and knowledgeable National Director of Planned Giving. We are delighted that you have joined us for this important conversation about your legacy. We all want to be as organized as possible in our homes, our offices, our savings, and investments. That is smart, efficient, and maximizes your growth, personal development, family security, and comfort. And although we may not want to think about it, no one lives forever. We know that. And that calls for thought that extends your love and values beyond your hopefully long and healthy lifetimes. This afternoon, we're going to explore the different avenues that exist for you to extend your love, caring, and values beyond your lifetime. Ort understands this, particularly because we provide young people not only an outstanding cutting edge education, but we offer a family atmosphere that addresses social, emotional, and spiritual needs of hundreds of thousands of our students. Especially in the past 2 years in Ukraine and the recent 12 months in Israel, we are assisting Jewish youth in the relocation and recovery from catastrophic events. This process will take years of caring therapists, teachers, counselors, and administrators' efforts. Ort functions as a long-distance family that concerns itself with the total well-being of 200,000 young people around the globe. This is why we are involved in legacy for our children abroad, as well as your own beneficiaries. Planned Giving brings security and comfort to those we each love and care about. To get to the important areas of legacy and salient details, I give you Ort's National Planned Giving Director, Robin Isaacson.
Thank you, Debbie. So my question to all of you is, why a planned gift? Why should you consider a planned gift rather than or in addition to your current support? It's because planned giving is about funding the future. Your gift will support a world beyond your wildest dreams. Imagine putting Ort in your will in 1990. For context, here is a look back at the world in 1990. Text messaging wasn't invented yet. Few people had cell phones. Google did not exist. Almost everybody used desktop computers. The internet was primarily used by scientists and academics. And if you had made a planned gift, would you ever have imagined that 30 years later, your gift would be funding programs that teach kids how to build and program robots, develop web-based applications to enable virtual learning, collaborate via live video chats across the globe, or create 3D printed prosthetics for people with lost limbs? A planned gift helps Ort secure the future. By learning today about the possibilities and taking that step, you will be funding initiatives and ideas for Ort that you couldn't possibly imagine today. Planned giving is about Ort's future. So with that in mind, I'd like to introduce today's speakers to give you ideas about how to make your financial wishes a reality and also fund Ort's future. They will each present, and then we will have an opportunity to ask them questions. Please feel free to type your questions in the chat, and we will get to as many as possible. And now to our first speaker. Chris Flohr is a trust consultant at Raymond James Trust in South Florida. His role is to work with financial advisors and their clients to educate them about trust and charitable services provided by Raymond James. Before joining Raymond James, he advised high net worth clients on complex estate planning and real estate matters as an associate with a Florida law firm. Chris earned both his Juris Doctor and bachelor's degrees from Florida State University. Chris is also a member of the Florida Bar and has earned the Certified Financial Planner designation. Chris, please present.
Thank you very much, Robin, and I appreciate the time today. I appreciate everybody joining to learn a little bit more how you can support in this great organization. So getting to what I'm going to speak on, and that's really ways that you can give other than a direct cash gift. So these are trust options and foundation and donor advised options that we would serve as a trustee or agent on here at Raymond James Trust. But we'd like to help you understand them and see if it's an option for you when you think about your plan to giving. So we could go through to the next slide, please. So the first item we'll talk about is a charitable remainder trust. And in a charitable remainder trust, the donor gives their property into the trust and then can receive income in the form of an annuity or a trust structure, annual distributions from these trusts, and then the remainder would go to charity. This is a IRS recognized vehicle that allows you to take a charitable deduction now based on the gift that was be given at the end of the either term or your lifetime as the grantor. So I mentioned an annuity or a unitrust structure. With an annuity structure, you'd be getting the same dollar amount in each year. A unitrust structure, they would revalue based on the assets in the trust each year. And then that's what your annual payment would be based on. So per IRS regulations, your payout to your beneficiaries, your non-charitable beneficiaries during the term, have to be between 5 and 50%. And in order to qualify, also, there must be projected at least 10% of the initial donation be available to the remainder charity, or in this instance. So, but one of the powerful things that this vehicle allows you to do is defer the capital gains on highly appreciated assets that you might have. So if you have stocks or real estate with very low cost basis that have appreciated in value, you can gift them into the trust, defer the capital gains immediately, pay them over time, and then with the remainder going to charity while you've been able to benefit during your lifetime. So if we go to the next option here, next slide, please, Charles. So that's a charitable lead trust. So this, you might think, the absolute inverse of the charitable remainder trust. So in a charitable lead trust, you would actually give property into a trust. The charity would receive payments immediately for a period of years, with the remainder then going to either the original grantor or their family. Less used vehicle, but it does allow you to transfer property to the next generation with a reduced cost, estate tax in many circumstances. And working with your CPA, you'll determine what would be better for you from a tax perspective to structure this as a grantor or a non-grantor trust. It's a little bit beyond what we'll get into today, but it is an important choice when you go through and make that plan. So going now to our next slide. Private foundations. This is one that people have probably heard a little bit more about than the last two that we talked about. And a private foundation is governed by a board or a trust structure. And what it allows you to do is give assets into a private foundation, and then from that foundation, contribute to charities of your choice or the board's choice from that standpoint. And they're privately funded, but they do have public financials. They're required each year to file a 990 PF, which Tony could get into more details on, I'm sure. But there's a 5% distribution requirement from private foundations for each year. And then there are excise taxes that you have to be aware of when you're investing your assets that are in your private foundation. Something to be aware of. We're going to go through in a second a chart that talks about the pros and cons of each of these. I just wanted to make sure that we highlight what the general purpose is here, and you see a little bit of a diagram to help you think about these items as we go through them. Now, next, we have a donor advised fund. And a donor advised fund operates a lot like a private foundation does, in that it allows you to contribute assets and have them grow over time in a tax exempt basis for contribution to charities. However, it is a public contribution to a 501c3. So your benefit from a tax deduction standpoint is going to be a little bit higher than it would be with a private foundation. I think we go to summarize some of these options here on our next slide. It'll help you understand some of the things that you're looking at when you do want to make these choices and consider these options with your professionals, your attorney and your CPA. But things to think about from a cost and setup standpoint. So charitable remainder trusts and charitable lead trusts and private foundations, they can't be set up immediately without some extensive planning that has to take place with your attorney and your CPA. Raymond James Trust can administer these vehicles for clients, but you'll still have to be working with a CPA and attorney as part of your planned giving strategy to do so. And because it does, cost money to establish these and run them, oftentimes what we see, people, our general recommendation is for around $1 million for these vehicles. That's what it would be for Raymond James Trust to administer them, but also for most individuals when it makes sense to do these. Now, there's other options available. For example, that's similar, very similar to a charitable remainder trust, is a charitable gift annuity. While not offered at Raymond James, I believe OrtAmerica has a charitable gift annuity that operates very similarly, and I know that Robin would be able to speak to the details of those. So that's a good solution if you are looking to receive income while putting off or waiting for that planned gift at the end of your lifetime. You'd like to get some income now, but also support your foundation at the end. That's a great way to go. Now, also immediately able to set up as a donor advised fund, very quick. As I said, it operates like a foundation. So if we have two individuals that we're speaking with and they're looking at making this kind of contribution, dollar amount and amount of money and time that they look to expend on running this vehicle is kind of where we go with a recommendation one way or the other. So on a smaller scale, especially that less than $1 million mark, a donor advised fund makes a lot of sense. It's very easily to administer. You're going to get that larger charitable deduction, as we mentioned earlier, 60% cash and 30% appreciated assets, as opposed to a private foundation where you would be receiving a deduction for up to 30% of AGI for cash and 20% for appreciated securities. Again, no excise tax due on the investments that are in a donor advised fund. So I think we can leave that up for replay purposes, but if you're looking to learn anything more about a donor advised fund and those programs available at Raymond James, you can visit raymondjamescharitable.org, where you can set up your donor advised fund directly from that website, pick your investment options. Also, any of Raymond James advisors, I'm sure, would be happy to assist you. I know Robin knows some that are on the board and very near and dear to Ort. So I will stop at this point and pass it off to our next speaker.
Thank you, Chris. And yes, we do have charitable gift annuities. Thank you for mentioning that. As a matter of fact, our rates are higher than the American Council on Gift Annuities. So if anybody wants to contact me about charitable gift annuities, I would be thrilled to have that conversation. Our second speaker is Jonathan Kukin. Jonathan has practiced exclusively in the tax planning area since 1987. Prior to joining Winnie Banta, he led the firm Kukin & Big, a boutique practice that focused on estate planning, tax, and corporate law. He co-chairs Winnie Banta's Tax, Trusts, and Estate Department and serves on the management committee. Jonathan represents closely held companies with a specific focus on family-controlled businesses. His legal expertise includes corporate planning, corporate transactions, charitable planning, and comprehensive estate planning, and has been recognized in the Bergen County media as one of the top tax lawyers. He is known for his quality legal advice and treating his clients as a member of the family. He is a sought-after speaker who is known for interjecting humor, which I can personally attest to, into difficult subject matter, as well as simplifying the complicated world of estate planning to the wider community. Jonathan was awarded the LLM in taxation by New York University School of Law, and on a personal note, I have worked with Jonathan in the world of planned giving over the last almost 15 years and have come to know him as someone that I admire with an amazing sense of humor and great integrity. Jonathan, the floor is yours.
Well, thank you so much. And thanks to Ort, Robin, Deborah, thank you. And my co-panelists, Chris and Tony, I really enjoyed the setup to date. And, Chris, I have to tell you, I did raise my hand there a minute ago. I was going to interject before we even started my piece. I just threw out all my charitable planning slides because yours are really, really excellent. And on that, I was going to say some issue spotting that I love, particularly from your the general comparison that getting a 1023 done for a private foundation, for example, is one of the big upfront costs. So when you compare a donor advised fund, what we call a DAF, to a private foundation, that's one of the big considerations. And during the course of today's session, we will be talking about the differences of tax planning during your lifetime as compared to death, because the deduction is vastly different, and also using your qualified plans. And when I say a qualified plan or retirement plan, I am generically referring to 401k, IRA, Roth IRA, 403b, SEP, KEO for people who are older. Any of those plans, they have a tremendous value when you're going to do charitable planning. And it really behooves everybody who has charitable inclinations to talk to Robin and talk to any of your panelists and your financial advisors. What's the best way to formulate it? So that being said, Chris, I appreciate and thank you for allowing me to use that as a jumping off point, and then I'll now deal with some of the topics. So Mike, if you go to my second slide, please. Perfect. So we're in a, we have an election next week, and that is the number one question I've been asked since the last election. Well, what's going to happen? And I'm hoping in my time allotted that I can explain the sunset provisions. Sunset provisions are, these happen automatically. On December 31st, 2025, new rules go into effect for what we call the estate tax exemption on the federal level. And, the reason that the executive branch and the legislative branch do sunset provisions is they don't want to deal with it. They don't want to talk about it. Everybody says, well, what if? So there are a lot of what ifs out there, and it may matter a lot if the Republicans do a clean sweep on the presidency, on the Senate, and in the House of Representatives. Then there's a chance that they would eliminate the sunset provisions. But if they don't take action, then the way the law was written from when President Trump doubled the exemption, sunset means it expires. So January 1, 2026, you are looking at a vastly different estate tax landscape. And it is something that, like I said, I educate the people now who are participating, but it's really what I spend a great deal of time with new and existing clients, explaining to them, as you can see here on the chart, in this year, which we are almost on November 1, the exemption is $13.610 million per person. And under what's known portability, a married couple has $27.220 million for a married couple. Let's just call it 27 million for ease right now. And January 1st, the IRS has issued what this exemption is going up to. So you see, so meaning even if you've done exempt giving previously at the $5 million, $6 million, $7 million level, you still have a fair amount of room to expand your gifting and not wait until death. And the exemption, the estate tax exemption, which is really the death tax exemption, that is, it doesn't matter that you were alive during this time period. It's what's the exemption when you're gone. And if the exemption is $6.5 million when you're gone, it doesn't matter that you lived during 2024 and 2025 unless you make those gifts. In 2025, that exemption goes up to almost $14 million per person. and almost $28 million for a married couple. This is tremendous leverage, and really what we're going to be spending the next 2 months of this year and the next 12 months next year. People who are in this category, they need to take advantage of this, because January 1, 2026, that gets cut in half. And, it is, truly a unique opportunity to, without even discussing discounting, stuffing more money into your children and grandchildren's future planning purposes for their usage. People make a big deal. I always discuss with clients, well, my estate tax planning really does nothing. If I do nothing for a husband and wife, their economic lives don't change. All of this planning is really to leave more money to children and grandchildren. And certainly the higher you get up on the exemption food chain, your charitable planning becomes even much more critical, because you have to make a decision. Am I going to pay tax to the government, or do I do a set aside, a percentage or a dollar amount to ORT or other charitable organizations and get a dollar for dollar offsetting charitable deduction, which saves a tremendous amount of taxes to the government. So cut a check to the government or cut a check to charity, doesn't matter to me, but I would like everybody on the, in the seminar today, and all my clients, to make informed decisions. Do what's in your best interest, and not just allowing it to develop on its own because you haven't planned for it. Will you be prepared? Preparation is knowing these amounts and having the proper wills, trusts, and going back to some of the things that Chris talked about, having a foundation, having a donor advised fund, making contributions at your death to your foundation or your donor advised fund. You have, Chris gave the remainder trust and the lead trust. We have nicknames or acronyms for everything. Those are what we call CRATs and CLUTs, or CLATs. Charitable remainder trust, charitable lead trust, tremendous amount of availability to do some real interesting planning, combining it with your lifetime giving and at death, and really allowing benefit to the charity and to your families. This main organization is out of Florida now. So Florida does not have an estate tax. New Jersey currently does not have an estate tax. But since this is a national seminar, and I'll make reference to New York because we're in the metropolitan area, New York is what we call decoupled. New York is a decoupled state. And everything I've said until now is true, but for a New York couple, New York does not accept portability. And the exemption for a New York client is essentially $6.9 million per person, per the husband and per the wife. It's not a married couple situation. So for anybody who's in a decoupled state, such as New York, got to pay very close attention. Who owns what you own, what will you own at death, and what to do about it. And some of the things we're going to talk about today as well are what we call the Secure Act implications. A lot of people will have a large estate, and it seems like, well, what does it matter? $1 is $1. Well, I often say $1 is $1, but not the same dollar is not necessarily equal. Sometimes I mean that saying that $1 in a trust has different variations than $1 in your pocket. In this case, the tax implications are vastly different. And if you have a qualified plan, a retirement plan, is a non-probate asset. It does not pass through your will. So if you have special provisions in there for children who have certain kinds of needs that they can't get the money outright, but your estate has your taxable estate has a larger amount in an IRA or a 401k plan, you have to be very proactive what to do about that and to make sure your beneficiary designations are appropriately done. Some of this will really be talked about more by Chris and by Tony in terms of income tax implications on what's known as RMD, required minimum distributions, and what happens on the estate tax end, and where do you make payable but I always talk about your non-probate estate and your probate estate. I call it the big ball. The big ball is your taxable estate. Of that taxable estate, some is non-probatable assets and some are probatable assets that pass through your will. You have to have a global plan and work that together from an income tax point of view, from a gift tax point of view, and from an estate tax point of view. And there are a lot of, very, very neat techniques to save you all around. And again, helping the Order of America and helping your family. And, listen, I'm in business to help people keep their money where they want it and not cut a big check to their state or to Uncle Sam. Not that there's anything wrong with it, but you're under no obligation to give taxes away just, again, because you don't have enough information to make an informed decision. Can we go to the next slide, please? So this one, it would be a corollary to what Chris has already done. I put it all together on, one slide of just saying, how do you maximize? And you really need to get into the details, which Chris put in his summary in terms of how long some of these things take to get proactive. And, I look at it, I want to get my clients biggest bang for your buck. And that is on an estate charitable deduction. Again, it's dollar for dollar. On things that you're doing during your lifetime, you are subject to income tax limitations. But these charitable bequests, retirement assets to optimize them, and what to use them with. And you see on the bottom there, it repeats some of the things, but in a more in the global way, without the detail of you have a lot of choices. A donor advised fund as compared to a private foundation. And again, I made reference to the remainder trust and the lead trust. Again, you must work closely. It's really big on a team approach. If you want to, retain Chris as your financial planner, Tony, your financial advisor, Tony as your CPA, and me as your lawyer, well, you're doing really well there because we work well together, we've worked well together, and you really need a team approach. And I can speak for both of them in that they are the commensurate team players, which is just a wonderful way to go about it. And if Order America is your donor designated place, your charitable designated place, the team combined with Robin, you will really do a tremendous amount for Ort and for your family and yourself. Next slide, please. And, every estate plan, and I already told you, we have a lot of these nicknames. You have vacation homes. There are some really tremendous techniques to do with that because you're not really giving dollars and cents out to your kids. You're giving shares out of a vacation home, particularly in our area, Jersey Shore homes or the Hamptons. The slat is probably the most popular technique because it's having your cake and eating it too. It stands for a spousal limited access trust. And it's a way to make a gift, get the gift out of your estate, show the growth out of your estate, but the other spouse, if you're the husband and you make a slat and you fund that slat, your wife will have the opportunity to dip into it if she needs it. It's a fail-safe, but it is a tremendous technique. And these are things that get things out of the estate. And we're not even talking about if you have a business or if you have assets that we can have a valuation discount where $1 gets discounted to maybe 66 cents on the dollar. Again, a lot of value in having the right people working with you to make these decisions. And the other acronym there is an ILIT, I-L-I-T, Irrevocable Life Insurance Trust. If you have life insurance and you have not discussed this with your financial advisor, your accountant, or your estate planning lawyer, wait till the end of the seminar, but call today. You should be doing something with life insurance. You are throwing money away if you keep that life insurance without knowledge about what you should be doing with it and what is the best way in making that life insurance death benefit disappear from your estate. And the last slide, please. Contact information. Everybody has it on their own slides. This is just the summary. Really, really good people here. thank you all for participating. Thank you for the opportunity. And I really appreciate, being on this panel and working on behalf of ORT. Thank you.
Thank you, Jonathan. As always, you do not disappoint. You are full of information. I just want to remind everybody that they can put their questions in the chat. We do have a few questions already, which we will bring up after Tony speaks. But if you have a question, please put it in there and we will get to the ones that we can. Our final speaker, last but not least, is Tony Torchia, a partner in Marcum's Saddlebrook office. He has over 35 years of experience covering a wide range of closely held businesses, including real estate, manufacturing, consumer product and food industries, entertainment, import and wholesale distribution, as well as legal and medical professionals. He primarily engages in tax planning and multi-state compliance issues for closely held entities, international companies, and their owners. He is a member of the firm's trust and estate taxation practice and retirement plan audit services. He has extensive experience in the areas of wealth preservation, income taxation, and estate planning for high net worth individuals, and has significant involvement in the transfer of family wealth to future generations through utilization of various grantor trusts, family limited partnerships, as well as charitable lead unit trusts and generation skipping trusts. Tony joined Marcum via a merger with Rottenberg Merrill in 2022. Tony, it's all yours.
Thank you so much, Robin. Truly appreciate it. And thank you, everybody at ORT. I think ORT, you've been a fantastic organization for so many years. And I truly appreciate you bringing us in and pulling this event together. And I want to thank everybody that is participating and also has decided to carve out some time to really protect your legacy. Thank you, Chris, and thank you, Jonathan. Going to feed off of some of your information that you've presented, maybe expand on it a little bit. But really, this webinar, it exemplifies how we need to pull various professionals together to really be advocates for our clients and build an efficient plan for their gift and estates. I'm going to just share my screen now with you. So that's one of the things that I've been called on more and more to really to work on with my client base. I've been practicing since 1985, and my focus over time, while I'm in many different industries, my passion has really been in the trust and estates world. I'm really advocating for my clients, pulling them together, utilizing the talents of Jonathan Kukin, utilizing Chris Filler, and many people at Raymond James, but also being able to talk to organizations such as ORT to make sure that not only that each person is advocating for the client, but also looking at the entire picture and what exactly are we trying to do to protect your legacy, your future for your generations. Let's see if so when we're looking at gift and estate planning, we take away just 3 basic objectives, which is preserving your wealth in the most tax efficient manner and planning your legacy. Right. So we pull apart those pieces and we build an inventory of your life, of your family, of your assets, and decide how can we most efficiently be able to protect your legacy and pass those to the next generation, or continue the philanthropy that you've built over your lifetime. A lot of the considerations are your lifetime needs, right? So some people say, Jonathan, you did a great job at bringing up the fact that 2025, we could be cutting the lifetime exemption in half. So a lot of my clients in the last year have come to me and said, I really should do something with this, but I'm not ready to give money to the kids. I'm not ready to transition my wealth. I need that for my life. I may be here another 20, 30 years. I want to make sure that I can utilize those funds or my spouse can utilize those funds. So, but we look at that, and there's many methods, as Jonathan and Chris have brought up, that allow you to do that. Also, we look at how do we have to safeguard your assets? Do you have a business, and are we taking into consideration the succession plan? Who are your current and future beneficiaries? And a key component to many of my clients is philanthropy. They care a lot about the causes that they've worked so hard to support over their lifetime, and they like to build that into benefiting the future, and also teaching their children, their grandchildren, to be able to how to do that and do that in the most efficient way. There's a lot of complexity and cost with some of the techniques that we talk about. So, anywhere from just getting a proper asset valuation. The higher cost, I think, is really not doing anything, and potential estate tax if things are done in an efficient or inefficient manner. We often look at balancing income taxes with capital gains tax, right? If I gift an asset during my lifetime to a beneficiary that has a low cost basis and a high value, I get the high value out of my estate. But then that beneficiary is burdened with the tax, where if I leave that high value, low basis asset in my estate, the beneficiary would get that at a stepped up basis. So then those type of items are where we have to utilize the various professionals, utilize Raymond James to look at your cost basis, look at the fair market value, look at the future potential of assets, utilize Jonathan to decide how to place these in the proper vehicle. We also have to look at who do you trust, your executors, your trustees, and how much flexibility do you need in your life. So why are we really doing this? Well, there are many different techniques, right? I mean, obviously the big one that Jonathan mentioned was the lifetime exclusion. That's $13.6 million, maybe cutting in half next year. We don't know. And that's per person. There may be state exclusions, as you pointed out, Jonathan, that are decoupled from the IRS exclusions. So those are important to take into consideration. Now, are you fully utilizing your annual gifting? That's something that's very simple. Or are you setting up 529 plans and super funding those? Some things that are very easy to do to try to reduce your states. If you're in a position where you're paying 40 to 50 cents on a dollar with an estate, every dollar that you put away is significant savings for your future beneficiaries. And also, some of the techniques utilizing current gifting will allow you to shelter growth. So as something grows in value, not only did you take that original asset out, but you also took the future growth out of your estate. We look at tips and trick techniques that are all compliant with IRS rules and regulations, involving discounting assets for any lack of control or marketability. We also try, like I said, to avoid reducing your taxes and utilizing life insurance and trusts. There's lots of different types of trust. And Jonathan, I see him smiling in the background. There's certainly a lot of different things. And I don't want to bore you with a lot of the details for these many different types of trusts, but I've utilized these many different ways, especially dynasty trust and special needs trust, charitable trust. But it's the type of thing that having the professionals that have knowledge of this and also a knowledge of you, right? You want to work not only with a professional that give you information out specific to a state trust and estate plan, also the professionals that you've been working with for many, many years. So we take an integrated approach, and many times I'm brought in by other CPA firms, other accountants, definitely by a lot of attorneys, to take a look at their estate and to make sure that if there's anything that we can be doing that we could think outside the box. We definitely want to take that into consideration. And one of the trusts, I think, Jonathan, you mentioned it quickly, that I think is of real interest more and more to many of my clients is the spousal lifetime access or spousal limited access, depending on how who you're talking to. But it's really an irrevocable trust, right? So that one spouse sets up for the other spouse. You got to be careful that there's not a reciprocal. In other words, some people say, well, I'll set it up for my wife, my wife will set up for me, or vice versa. So there's a lot of reciprocal trust doctrines that we have to be very careful with here. But this is a good area where you could potentially gift to your spouse, utilize your lifetime exclusion, but still your spouse has access to those funds during their lifetime. And you obviously will be able to benefit to some extent from that situation. Yeah, as long as you're nice to your spouse, of course. So looking at, some of, what somebody say, well, what's my benefit? Why should I do these types of things now? Currently the lifetime exemptions, like you said, is 13.6. And if the government does nothing, which I think, we can all probably say that the government sometimes is pretty good at doing nothing, and the exemption sunsets, which is automatic, we're looking at $7 million. So you could do nothing next year. And if it sunsets, you're losing $6.6 million of lifetime exclusion. That's going to cost your beneficiaries, right? It won't cost you, it'll cost your beneficiaries $2.6 million. And that's it. That's everybody doing nothing, and the government gets more money. Now, what if we do something? What if we do place $5 million into some type of a trust, and it continues to grow over 20 years? The trusts don't have to necessarily be tied to your lifetime. They can be tied to beneficiaries. But if you look at that, the growth, 5%, 7%, 9% growth, and the tax savings, assuming that there is an estate tax, with the 7% growth after 20 years on $5 million, you're saving, the trust might be worth $19 million, and you're saving $6 million. So you're saving more than the initial investment that you made in your future and your family's future. So I know we covered a lot. There was a couple other topics that I wanted to talk about. I think Jonathan and Chris, you also mentioned the Secure Act, the IRAs. There's been a lot of discussion, probably you've heard the terminology of stretch IRA, where you're taking certain beneficiaries have to take the benefit over 10 years. There's been some discussion, well, do you have to take it every year? Can you take it in the 10th year? So those are items that I think you have to sit with your professionals, look at how did you receive your funds? Is this your personal IRA where you were mandated to take a required minimum distribution? Is this an inherited IRA where you have to take either over 10 years, or perhaps you are an eligible designated beneficiary where the 10-year rules may not apply to you? But typically with the new Secure Act, those that are not eligible designated beneficiaries and have an inherited IRA have to take those distributions over a 10-year period of time. So general rule of thumb, again, you have to look at the specifics of your particular situation. So I think I kicked around a lot. Plenty of other things that I want to talk about. But again, thank you for taking some time to listen to us. Thank you for not only bringing this together, but also for everything that you've done over the many years in supporting our children and our future.
Thank you, Tony. And thank you all, gentlemen. We already have a few questions, so I'd like to remind everyone that if you have questions, please feel free to put them in the chat. So this is going to be really interesting because these questions could actually be given to any of our three panelists. So I'm going to throw the questions out there, call on one of you first, but feel free for the others to jump in because I realize that these questions can be answered from a financial, a legal, and an accounting perspective. So I'm just going to throw them out there as they come in. The first one I'm going to direct to Tony, which came in and happens to be a question I get all the time. First, people say, well, what's the difference between a QCD and RMD? Why would I gift directly from my IRA rather than from other funds? What's the benefit for that gift rather than just, a straight up gift to Ord America? And why, and then that would lead into the conversation of the CGA, which will be my next question. Why should I set up a CGA with an IRA and what's the benefit? So Tony, I'm going to throw that out there to you first, and hopefully Jonathan and Chris will chime in on that.
Certainly. So happy to talk about that. So, again, what we like to do is we like to look at various assets when we're planning what you're going to do with those, whether gifting or you have to take those distributions, and make a determination what the most efficient way to do this. When you're gifting directly from your IRA, every year you may be required to take your RMD. And you may say, well, why don't I take $10,000 in cash, just give it to Ord? Why am I doing it from my IRA funds? Well, number one, you're utilizing your IRA and taking care of your RMD, but also what you're doing is you're reducing your adjusted gross income, because that contribution, while it counts towards your RMD, it does not show up when you're filing your tax returns. So what does that allow you to do? Well, maybe you have some medical expenses that you're paying. Well, your medical expenses have to be in excess of 10% of your adjusted gross income. So if you can reduce your adjusted gross income, you would reduce that amount that they have to go over, and therefore increase your tax benefit by getting an additional deduction, and effectively save taxes by gifting your RMD instead of giving cash or other assets.
Okay. Anybody else want to chime in? Jonathan, Chris? Okay, moving on. Chris, I believe this one might go to you first. Okay. Why would someone use a donor-advised fund? And are there other ways that you didn't mention to get a charitable deduction now and still receive income? And I just want to throw in there, which wasn't part of the question, include CGAs in there, charitable gift annuities, because we have a very robust charitable gift annuity program. As I mentioned, our rates are higher than the American Council on Gift Annuities. And there are tremendous benefits now before everything sunsets, where people can get deductions. They can make the donation directly from their IRA. So if you could start that one off and then maybe go around and...
Sure, absolutely.
Thank you.
Yeah, I think a little bit of a clarifying point there too. With a donor advised fund, you're not actually going to be able to receive income from the donor advised fund. The donor advised fund can grow tax-free, and those contributions and growth would be given to other 501c3s such as Ord. But with a donor advised fund, that gift is made and you're not going to be able to receive income back from it. So an analog to a donor advised fund would be more, why would we give to a donor advised fund rather than a direct cash gift? Or why would we give to a donor advised fund as opposed to utilizing a private foundation? And from that standpoint, on the cash side, you can get a larger deduction now if you're not willing to, or not really ready to gift all of that amount in a given year. From a private foundation side, it's going to be more cost effective and efficient for you. But getting to the charitable gift annuity, And these are all generalities, let me say. It depends on everybody's circumstances, whether or not one or the other is more appropriate for them. But then getting to the charitable gift annuity, that's really an analog to a charitable remainder trust. And the charitable remainder trust, in like we had talked about with the private foundation or other type of trust structure, there is some setup involved, and you're going to see your attorney, and you're going to have to properly value assets depending on what's going to be contributed to that charitable remainder trust. And so looking at a charitable gift annuity, as opposed to that, it is more of an off-the-shelf solution, but doesn't mean that it should be entered into with any less consideration as to the appropriateness for it. But it is a great vehicle, especially if you have an organization that offers one, because not all organizations do. So it's a great vehicle to be able to receive income now, and also benefit charity at the end of that term.
Thank you, Chris. Jonathan?
Chris handled that general point of view, which was great. The only thing I was going to add is when I look at clients' IRAs, 401ks, the big issue that we explore is from an estate tax, an estate planning point of view. I call it, they're the worst assets to have because they're part of your taxable estate. And then when your beneficiaries take out those monies, it's also income taxable because the income tax was deferred. So I love using that type of IRA or 401k, and when appropriate, allowing that after the death of the spouses to go to a charity, because now I remove the asset from the estate and I remove the income tax from the family. So it's a unique perspective that I'm not dealing, I need a team to say, when they should take it out on an income tax side or from an estate tax side. If all things are equal and they want to get their kids the $1 million and they have $1 million in IRA, $1 million elsewhere, there is an increase to the family, and they want to have a charitable contribution. Utilizing some of that IRA for the charitable side will be cost benefit analysis, allows the family and the charity to come out ahead.
Great.
But as Tony and Chris have both said, these are not cookie cutter solutions. Every client, the reason we need detailed analysis on the financial end is not because I want to know what your net worth is. Net worth is only a function. Do you need tax planning, and what's the makeup of that net worth? Because we want to maximize what you're keeping and what you're giving away and why. And that's how I can quantify it.
Perfect. Okay, we have 2 more questions because we'll try to stay, within our time frame. I believe, Tony, you mentioned this, but of course it's open to everybody. My husband and I have fully utilized our personal lifetime estate exclusion. What else should we do?
That's excellent.
Oh.
So again, that goes back to utilizing various trust techniques to shelter growth. So while you've utilized your full lifetime exemption, gifts between spouses are not subject to the exemption. But you should also take a look and what assets do I have, and what are my plans with those assets? Part of your plan may be that you want to be charitable, so you can use the various techniques that we talked about, the charitable annuities and other items to start to give during your lifetime or benefit from it during your lifetime, and with a remainderment going to a charity. So I think there's a plethora of things that you can do, but again, it's looking at your scenario and looking with your professionals at what's the best to accomplish your goals.
Okay. So this last, oh, go ahead, Jonathan.
I don't know if you need to repeat the question, but jumping off the question and what Tony said, okay, I have somebody who's used their total exemption. Well, the IRS rules just came out for 2025. So my first step would be, you still have some capacity for 2025, number one. Number two, I don't take anything for granted. Have they been making annual exclusion gifts? Have they been making annual exclusion gifts not just to their children, but to grandchildren or possibly great-grandchildren? If I have somebody in that net worth arena, I want to make sure that they're maximizing. So you might have used your lifetime exclusion, but are you still making those annual exclusion gifts? And are there other beneficiaries out there that you may not have utilized to date? And again, how best to do it. And lastly, then if you've done all of that and you still want to have some avoidance issues or to not pay the tax in a nicer term, then you, again, bring that charitable element into it. If you're in that unique case and you have those dollars and cents and you say you've used your full exemption.
Great, thank you. Now, this final question is a two-parter, and since it's our final question, I think everybody should take a stab at it. And it's two parts. So, Jonathan, referring back to your estate planning tax savings slide, which techniques are the most popular and why? And is there anything more you want to tell us about the Secure Act? So we'll start with Jonathan, we'll go to Chris, and then we'll go to Tony, and then we will do our close. So Jonathan.
Right. Using the nomenclature that everybody's referred to, the personal residence trust, we call it QPRIC, Qualified Personal Residence Trust, for a vacation home, using sometimes we use LLC. In an LLC, give me a standard LLC. All of a sudden, I explain to a client, you want to keep control? I'm going to give you the voting, and I'm going to give out non-voting to the family members of the trust, or kids, grandkids. That's out there. That the spousal limited access trust, tremendous piece of planning, and the irrevocable life insurance trust. And that's not even touching anything on the charitable side. And we also have a bunch of nifty plans, for that. But, those are the bread and butter. There are some other things, and I could just throw a bunch of names and titles out, and you're all going to say, huh? But again, that's why we have to, we look at each client is quite unique in what they're looking or willing to do. And so I'm giving you the big global picture. And like I say, bread and butter, tried and true. This works well. And this is why clients like it.
Okay. Anything more you want to say about the Secure Act? That was the second part.
No, because okay. I felt that I dealt with it, and that gets that is truly detailed. And when you did the QCD, things like that, again, I would defer a lot, to my part of the accounting team to make sure they're maximizing that. But I will, in Brady Bunch fashion, pass it over to Chris.
Great,
Excellent.
Chris.
Thanks, Jonathan. I would agree that as far as popularity right now, the spousal lifetime access trust is going to be the thing that most of our clients are looking at, because it helps them be comfortable that they can still reach into those trusts indirectly via the spouse to use those assets if needed. On the charitable side, I would say the donor advised fund is what most clients use. On the trust side, the charitable remainder trust is a CRUT or a CRAT is going to be the most popular. One of the things like says bleeding into the Secure Act a little bit. Tony mentioned the stretch IRA, and that's essentially kind of done since the Secure Act's been imposed. So some family members that we have, we've seen using testamentary CRTs to kind of duplicate that stretch, especially for, parents that might be concerned about children spending all of that IRA money in year one or in year 10, whatever it might be, if there's a large, qualified account. So doing a testamentary charitable remainder trust with the IRA proceeds is something that we have seen, related to the Secure Act, not as popular, but one method that we've seen people go and use. On the Secure Act side, I think that it's difficult. You're going to have to look at each and every situation. Finally, the IRS has given some terms, some more concrete guidance after a number of years of waiting. But the qualified charitable contribution, as Tony mentioned earlier, or distribution, the QCD from the IRA, and he took it even further, as far as offsetting some of your other expenses to reduce AGI, but not realizing that income and giving the same amount directly out to charity is powerful, especially counting against your RMD.
Thank you, Chris. Tony, is there anything left unsaid?
Listen, my co-hosts have done an excellent job. So, but I would add there, and I agree with everybody. The SLAT seems to be the flavor of the last couple of years, or even the last 7 years. But certainly people that have done planning, like to, one of the things I often hear, I love my children, but I got to protect them from themselves. So, and I need the money during my lifetime. So that is a great reason to have this SLAT. But there's a couple of things, I don't know if we touched base on them in terms of charitable giving. One of the things that we often look at is, somebody may have 100,000 in Apple stock that they bought for $1 a share or $4 a share, and they may have 100,000 in cash. And I say, well, let's give the Apple stock, right? I mean, we want to give appreciated assets with a low cost basis to charities instead of giving them the cash. Why? Because not only do we get the charitable deduction, but we don't pay taxes on the capital gains. So that's a great benefit. I think that's something that everybody should be looking at with their charitable giving, rather than giving cash, giving appreciated stock to organizations such as ORT. I think it's a great benefit.
Great. Thank you. You're right. And we did not mention that. And many IRAs have been established through stock transfers. And that's a great comment. Thank you.
You're welcome.
Anything else?
A new technique that we're doing to reduce estates is Roth conversions. So that's something that definitely is coming into favor to significantly reduce the taxable estate, take care of the tax, and then give the benefit of extended growth in IRAs to benefit future beneficiaries. It's something that we like to sit down with the clients and say, let's pay the tax now and keep the growth and keep your estate taxes lower. I think that covers a lot of things that we like to talk about. Thank you so much, Robin. Truly appreciate it.
Thank you guys so much. As you can see, we could probably go on for a long time. But before we sign off, I'd like to turn it over once again to Debbie to close. Please stay on for a final slide with contact information so you know how to get in touch with us, so we can put you in touch with our amazing experts who have so much more to say and all they want to do is help. So Debbie?
Well, I hope each of you was able to pick up either helpful tips or a whole new way to view your legacy. As you make your eventual plans, it is hoped that you will do so in a confident manner in collaboration with your lawyer, CPA, and financial planner. And we hope you will consider the many students around the globe that depend on us, and you will include ORT in those plans. We want to thank each of our speakers for their expertise, presentation, and preparation on our behalf. To Jonathan, Tony, Chris, we are very grateful. To each of you who tuned in today, we thank you for your participation. If you have questions or want to get in touch with our speakers, please contact Robin and she can put you in touch with them. Now, go and enjoy the day.
And Robin,